Hello and welcome to Economic Forum, a program in which we discuss various issues affecting our economy in Zimbabwe. On the 27th of June, the Minister of Finance and Economic Development, Professor Ncube, announced a number of measures which were meant to stabilize our exchange control rates as well as the availability of basic commodities. It also looked at the salaries of civil servants, the availability of fuel, among many other things. In this program, we're also going to be talking about the gold coins, which are part of these measures that have been introduced. And to do all that, we've invited an economist, Leonard Chitongo, who is going to be unpacking and clarifying some of the issues that the public may want to know. Leonard, welcome to Economic Forum.
Thank you very much, John, for inviting me to your program. Yes, you're right. On the 27th of June, 2022, the Honorable Minister of Finance did announce some measures which were a precursor to the issuance of a statutory instrument which was subsequently issued, which actually is now law. Also related to that was the Monetary Policy Committee meeting of the Reserve Bank, which was held on the 24th of June. Again, it gave some guidance in terms of what needed to be done to stabilize the exchange rate and also control the runaway inflation. You may be aware that inflation officially as of June was about 30% month on month and 191% year on year. And those figures are significant compared to where we were in the last 2 years or so. So there was concern from the authorities, both fiscal authorities in terms of Ministry of Finance and also monetary policy in terms of the Reserve Bank, which is charged with the management of monetary policy. And those two statements really set the tone for the statutory instrument that eventually came.
Now let's look at the measures themselves. In fact, what's interesting is that there was emphasis on the fact that the multi-currency system is there to stay. And yet we see informally that the multi-currency system, yes, is there to stay, but the US dollar is actually dominating because our economy is informal. If you could start by explaining from there.
Okay, I think if you look at that particular measure, what was said by the minister, which is subsequently reflected in the statutory instrument, is that the multi-currency system has been in place since 2009. You remember, after the hyperinflation era, and it has been in operation in different forms and mainly anchored on the US dollars. If you recall, in 2009, there were 5 anchor currencies: the US dollar, the British pound sterling, the rand, the euro, and the Botswana pula. So there was what was called the basket, but with the anchor currency being the US dollar. That's why you find since then the US dollar is the dominant currency. And also, if you see the system that is used by the financial system, is that they use cross-exchange rates to calculate the value if, for instance, you're going to be transacting in a currency which is not the US dollar. So the US dollar is dominant in the market, and it's actually the anchor currency in terms of the pricing of goods and services in the economy.
Maybe you can explain, Leonard, why, with that background, despite the calls that have been made by different people, the government does not actually formalize our economy as a US dollar economy.
Okay, that's interesting, because if you look at the introduction of the multi-currency system in 2009, we subsequently went into a GNU, where we actually dollarized to a great extent. The economy was run on US dollar, and for the period, and things stabilized in terms of inflation, and also in terms of for the general economic outlook, because people were earning in foreign currency and so forth. But the problem with being 100% dollarized is that it impacts on the competitiveness of the economy. You know, for you to earn US dollars, you have to produce internally and then export and earn foreign currency. But if you're in a situation where you're producing and your costs are denominated in US dollars, it's going to make you more expensive in terms of your production costs, which would mean that if you look now at your selling prices, particularly if you're selling to our neighbors, your prices will become uncompetitive. And that's the situation which then later on led to the drifting into the RTGS, which eventually was converted into a currency.
Say something, Leonard, about the availability of fuel, grain, and so forth, which was also emphasized in those measures.
I think those were inflation controlling measures in terms of, fuel is priced in foreign currency, and any price changes in the fuel immediately triggers price changes within the economy.
And very briefly, grain.
Well, the grain is related to the shortage. We expected a bumper season compared to last season, but what happened, unfortunately, we did have intermittent rains, and as a result, we did not get that much in terms of harvest. So the country is now starting to face a shortage, and the minister's emphasis was that they do have sufficient in the grain reserves, which they will actually bring to the market, and where necessary, they'll be importing.
Yes, Leonard Chitongo, an economist who is our guest today on the Economic Forum and unpacking the measures that were announced on the 27th of June by the Minister of Finance and Economic Development, Professor Mthuli Ncube. We'll continue in the second segment, so join us then. We are now in the second segment of Economic Forum, where today we are discussing and unpacking the measures that were introduced by the Minister of Finance and Economic Development, Professor Mthuli Ncube, on the 27th of June. Such measures that include issues to do with the multi-currency being here to stay, as well as entrenching the interbank into law under the NDS 1 period. And Leonard is going to explain that as he goes ahead with our program, as well as fuel, grain, and other things. Yes, Leonard, this was culminated by the meeting of the Reserve Bank Advisory Committee on the 24th of June. So if you can take it from there, what is it that was discussed and how are these measures going to be implemented?
Thank you, John. The Monetary Policy Committee meeting of the 24th of June was quite significant in a number of ways. The first major provision which was agreed there related to the adjustment of interest rates to curtail speculative borrowing, which has been fueling activities on the parallel market and also investments on the stock exchange. I think the level of increase of rates of the bank accommodation rate and also of the lending rate to the banks by the central bank to 200% was quite significant, and the market is feeling as if it's going to be choking, particularly for those companies that rely on borrowing for working capital requirements. Normally, because of the levels of our interest rates, companies actually look at using bank financing for them to finance their short-term requirements. But the impact really of that particular measure is that if you look at interest rates, it's really the price of money, either price of money of your local currency or price of money in terms of your foreign currency if you look at the exchange rate. And what banks do is they use a formula of what is called the average weighted cost of capital, which means they are basically saying if you're going to source part of your money from deposits and also part from the accommodation from the central bank, or also lending by the central bank, and any other sources they could have of local currency, then they weight that, and that's the rate which they will charge to the market when consumers go. So if you see the best bank rate at 200%, it's quite significant, and it's going to affect the market in terms of the borrowing by companies. The other measure related to the accommodation of companies in terms of the export earnings and how they would manage the export proceeds that they receive from export earnings. This is surrender 20% automatically when the receipts are received, and this time around the central bank was saying that they want to accommodate the situation in terms of fluidity and flow of currency in the economy.
Why are they, Leonard? These are measures that are meant to even stop the spiraling of the black market and so forth. Is this the first time that such measures have been introduced? Or this is an improvement on what was done in the past?
Well, it's not the first time that they were introduced. What the central bank would do is they will look at the market conditions and see what is appropriate at that particular time, and then they will implement appropriate measures that will ensure that the policy intention is actually addressed. You would find the other measures related to that, besides the best bank rate, was the issue relating to statutory reserves. And this is the deposits which the banks will keep in their accounts at the central bank. That was kept at the same level, and the logic is actually to say that they don't think that will affect liquidity in the market. So the central bank will look at those factors and see if there's need to do adjustments to ensure that you actually then manage the market situation that you want to look at. If you look, as I said, the price of money, you're basically looking at being very steep in terms of the levels that you're looking at, and that certainly is going to discourage borrowing and hopefully stabilize the liquidity situation in the market.
The other thing is confidence in those who are running the economy. That's one other thing that you may end this segment by actually explaining, is there confidence? You mentioned this committee, which I believe also comprises people from various walks of life. And when the blame is made, it's put squarely on the minister and government. Just very briefly, confidence.
Well, confidence is obviously a key factor. Even the minister himself has indicated that there is a deficit of confidence, to use this expression, particularly in the expectations of what happened on the currency market and with inflation. You would find that economists have what they call rational expectations. And rational expectations is saying that if you look at human rationality, if you look at information available in the market, and also if you look at previous experience, those are going to affect the way the market will operate and the way people react to any policy measure.
And that's Leonard Chitongo, an economist, who is explaining the measures that were introduced by the Minister of Finance and Economic Development, Professor Mthuli Ncube, is unpacking them so that they are fully understood. Measures that are to do with foreign currency, the interbank exchange rates, as well as the availability of fuel and grain and so forth. We are also not going to forget, Leonard, to talk about the gold coins. So join us in the third and final segment of Economic Forum. We are now in the third and final segment of Economic Forum, where we are discussing recent measures in order to stabilize the exchange rate, as well as other issues to stabilize our economy and also build confidence and trust in those who are running it. And we have Leonard Chitongo here, an economist who is unpacking and explaining all those things. The other thing that we cannot leave this program without explaining, Leonard, which is part, I think, of the decision that came from the committee that you mentioned from the Reserve Bank, is the minting of gold coins. And everyone is looking forward to that. What is it and how is it going to add value?
Okay, thank you, John. I think there's a lot of excitement in the market about gold coins. I think you cannot fault people for that, because gold traditionally, from time immemorial, before even money was introduced, is a good measure of store of value. So you'd find in times where you either have wars or in times where you got economic turmoil, gold always acts as a good hedge. And I think the thought of doing that in terms of introducing gold coins, you can see the excitement in the market. I think what I would
Is it
say,
because, Leonard, everyone is out there looking for gold?
well, this time around people will be looking for gold because the coins are going to be widely available within the banking system and other institutions mentioned by the Reserve Bank. But the key thing I wanted to emphasize, John, is that if you look at gold coins, the measure, the Monetary Policy Committee actually say it's meant to make gold as a store of value, which means if you got your US dollars, even if you also have your bond, or if you have any other currency, you can actually buy the bond, the gold coins as a store of value. And that in itself is important. And that's what the market needs to understand in saying that if it's a store of value, it means it's not really meant for transactional activities. And by that I mean you're not going to go into a supermarket with your gold coins and want to transact. Yes. That's not really the essence. It's meant to say if you have excess Zim dollars, for instance, and you can afford to buy the gold coins, you can actually convert that, and actually it's a good hedge because it means you're going to maintain the value of your money even if the currency depreciates and your Zim dollar actually gets worse. And it's actually would be smart because the interest rates on deposits, which were announced by the central bank on the same day at 40% compared to inflation, you are in the realm of what economists call negative real interest rates, which means your money actually, if you put it in the bank, is losing value.
Is there no danger of this gold or these gold coins being taken outside the country?
Well, I think the authorities are well aware of that fact. They said you can actually trade them even outside the country. Okay. The key thing is maintaining the purity of the gold. That's what's going to be important.
Whether locally or internationally.
Exactly, because that's the test of it. I think it's the United States of America where we do have the minting of 100% gold coins. Other economies, like the Krugerrand in South Africa, for instance, they do have that as a gold coin, but the purity level normally is within the 90 to 91% level. And those are things which the central bank is now going to pronounce. And my advice is that people should have a bit of patience and have a well-considered and measured response to it instead of rushing into it, because all these measures will then be announced to say the price is going to be based on the London bullion market, which is the gold price market, which issues the price of gold on a daily basis. Then it means if the gold price is going up, the value of your investment is going up as well. Yes. If you want liquidity, you then go to your bank and you liquidate your gold coins and you then go and transact in a supermarket or for whatever purpose
So much about the gold coins there, viewers, from Leonard Chitongo, our guest today, who is explaining what value they have and so forth. You know, this has been trending on social media and so forth. And I think, Leonard, you've answered most of the questions. But you, as an investment economist, just a few points that you would like to mention about the impact of these measures on investment before we close.
Okay, that's a very important question, John, because really, at the end of the day, these measures are put in place so that economic actors can come through and adopt them and behave in a particular manner. So you'd find from an investment perspective, you need to have a policy framework, either as a corporate or as an institution, even at the level of an individual. What policy do I have in terms of excess money that I have? And then once you do that, you actually go on to what we call asset allocation. Where do I want to put my money? Is it in property? Is it in money market instruments? Now an option, gold coins. They even exchange traded funds which have started on the stock exchange, which perhaps we can talk about some other day. So there are so many options where you now need to look and say, where do I put my money? And quickly, in terms of the impact on investments, you would find that on the interest rates, it's going to discourage short-term investments in the money market because deposit rates are low, 40%. And if you look at the forex, I think the advantage is that banks may start to also look at options to actually lend money in foreign currency, because now you can actually use that as a trading currency over and above your Zimbabwe dollar-denominated investments. So if you look at that, you're saying it's opening up avenues to look at other alternatives or other asset classes that you can look at investing in as an investor or even as an individual.
Yes. And finally, what are you hearing from the market ever since these measures were announced as we close?
Well, I think the market is cautiously optimistic in terms of the impact that the measures are going to have. The gold coins, as I said, is still open-ended in terms of how that is going to pan out. We still need more information on the trading before officially they come onto the market on the 25th of July. The interest rates, as I said, short-term, it's going to be subdued because interest rates are so high, and I guess that was part of the policy intention to do that.
Yes. Leonard Chitongo, I would like to thank you very much for coming to Economic Forum. That's economist Leonard Chitongo, who has been explaining the measures or unpacking and simplifying the measures that were introduced on the 27th of June by the Minister of Finance and Economic Development, Professor Mthuli Ncube, and also he was able to elaborate on the much needed or much looked forward to or gold coins. So on that note, I would like to remind you that you can get in touch with us on the numbers that show on your screen, as well as get in touch on the social media platforms that we also display. And for those who miss some of the episodes, you can actually view them, watch them on our YouTube channel, which is Economic Forum Zimbabwe. So on behalf of Leonard Chitongo and the production crew, this is John Masugu.